Hello, and thank you for joining us for today's episode of the On the Mark Financial Forum and Podcast. I'm excited about this topic today. We are going to be talking about creative financing for investors. It's one of my all-time favorite topics to talk about because I think there are so many opportunities out there that people just don't know about, and our goal is to try to get that information out there. So thank you for joining us. Today, we're going to be talking about some of the common challenges that investors have. So I'm an investor myself. I experience some of these same challenges that you might be facing, and my goal is to try to raise awareness about different solutions of things that you can do to try to overcome those challenges. So one of the biggest challenges we see that kind of holds investors back, including myself at times, is raising the capital that you need for a certain project, whether it be for a down payment, maybe the property needs renovation, to be rented for top dollar. It could be for just about anything, maybe an operating account. But raising capital is one of the biggest challenges. And I think oftentimes people think about investing only by themselves, and sometimes there are opportunities to also invest with other people as well. And that might speed up the time at which you have enough money saved to be able to complete a transaction. The other challenge we see often is people having access to capital once you already own a property and you have a tenant turnover, which is inevitable. People are going to move. Renters tend to move fairly often. So maybe every 1 to 2 years, you might have a vacancy. And usually there's some wear and tear on the unit that you want to clean up a little bit before the next tenant moves in. And so managing what we call turns, or the period between when one tenant moves out and when you're ready to start showing to new tenants and having them excited about the property is another challenge, is just having the funds available to do repairs. And sometimes tenants really tear a place apart. You hope that they don't, but sometimes they do put holes in the wall, or who knows what. We've seen all sorts of crazy things. So you have to make sure you have funds available as an investor to be able to accommodate those issues that you sometimes just don't even know are happening until you do your final inspection on the property after somebody moves out or as they're moving out. One of the other common challenges is that right now prices really haven't come down, despite the fact that at the moment, which we're recording this in November of 2024, interest rates are still elevated. They had gone down a little bit and now they've come back up. We're in the neighborhood of 7% interest rates again. And that creates a challenge. Like, how do you get good cash flow from an investment if you're having to pay a high price and also potentially having to take a mortgage that has a little bit higher rate? In my opinion, that's actually a period of opportunity where you might find deals that other people, especially owner occupants, may be scared to buy. So we may see demand start to soften. We've already seen that a little bit in some markets where supply is rising and demand is, not falling off, but it's not growing because interest rates are still elevated in some cases. So that's a challenge that investors often find, because ideally you want to find a property that has appreciation opportunity, but also good cash flow. So if you're paying a high mortgage payment, it's hard to get that cash flow unless you're getting a really good deal on a property, or unless you're buying in an area where market rents are relatively high compared to the prices that you need to pay for a property. Sometimes we find that investors also have the challenge where maybe they own their home and then decided to keep it as a rental, or they got an investment property loan, 3-4 years ago when interest rates were at a low. I have this challenge myself. I refinanced all of my mortgages on my investment properties a few years back. And so they're all in the threes. And there's no way I'm going to get that rate again, probably ever. But if I need to take out capital to fund my next project, the last thing I want to do is get rid of that mortgage if I don't have to. So we'll talk about some creative solutions that you can do to go in second lien position, where you can leave that existing loan in place if you have one that's really attractive, and still be able to pull equity out of your property to do your next project. And then one of the biggest challenges we see often when clients are calling us for mortgage applications is that they just don't qualify for conventional financing. It's really tough as an investor to look good on paper because there are so many tax write-offs. There are expenses that you can write off against the property for renovations and things like that, repairs that may make it look like you're not making any money, even if you are. So investors oftentimes have a hard time qualifying, even if they have a job separate from investing and they're more of a side hustle investor. It's still difficult to qualify for conventional loans. So we're going to talk through some of the most popular investor loan products that people can take advantage of, even if they don't meet traditional criteria, where maybe their income isn't sufficient on paper to qualify for a more traditional loan. There are other loans that are actually very comparable in rate that don't require all that general qualification requirements. So let's talk about some of the creative financing products. So one of the most common ways to pull equity out of a property if you already own one is what we call a cash out refinance. Now that could be used to raise capital for a down payment on another property. It could be used to build up a reserve fund. It could be used for just about anything. It could be for renovations or turns on the property where you need to have a little bit of a reserve left over so that if your tenant does damage your property, that you have money readily available to fix it, because you don't want to be sitting and waiting to try to get that capital while your unit is sitting vacant. But the idea here is to put your equity to use. So the rate of return on equity in a property is zero, meaning the property will appreciate at the same rate regardless of how much debt you have against it. So if you're able to still cash flow on a property while you're cashing out equity, that's a great way to be able to grow your portfolio, because maybe instead of owning one property, now you can own 2 or 3. And you can really start to multiply the value of your overall portfolio of properties. So cash out refi is one great way to do that. Another way to do it is a line of credit or a second mortgage. So this is a great solution when you have that existing mortgage in place that's at a really low rate that you don't want to touch, because your cash flow would be better, even though rates on second mortgages tend to be higher than primary mortgages because they're in second position, so less attractive for a lender. Higher risk usually means higher rates. It's a great solution to be able to still pull that equity out without messing with the existing mortgage that you have. It's also a great tool when you want to have access to funds, but you don't actually need to use them right away. So a couple of examples would be trying to manage the turnover of tenants. Right? If you need access to money just in case you need it, but you don't know if the tenant's going to do damage to your property or not, if it needs to be repainted or fixed in some way, a line of credit can be a great way to just have access to the money. And the beautiful thing about it is that you typically don't pay interest on any amount that you haven't borrowed. So if you don't end up using it, you're not paying interest in the meantime. That's one of the differences between the line of credit and a cash out refinance. When you do a cash out refinance, you're getting a lump sum of cash and you're going to pay interest on it until you pay it back. Whereas a line of credit, you can borrow against it. You pay interest on whatever you borrowed, then you can pay it down, then you can borrow it again, pay it down, borrow it again, pay it down. So it's also great for people who flip properties, who want to turn that financing over relatively quickly and may want to rinse and repeat, so to speak, as far as using those funds on multiple occasions. But it's great to have access to capital from the equity of your properties to be able to do anything. Could be renovations. I've used one to renovate. I use a line of credit on one of my properties to renovate a different property and add an ADU, or additional dwelling unit, which is a converted garage, which added $2,500 a month in rental income to that property that it didn't have previously. So there are some great things that you can do, and it can also just be a great resource to be able to have access to capital, even if you don't need it right away. As an investor, you want to be prepared for those unexpected expenses. They can come, they can happen. I've had plenty of experiences on my end where I needed capital on short notice. You don't want to pay for that stuff on credit cards if you don't have to. I'll give a quick example. The Department of Water and Power had a power surge on the pole next to one of my rental properties, and it just fried the whole electrical system. We had outlets popping out of the wall. We had to replace electrical panels for both of the units. We had appliances that were fried, the motherboard of the HVAC. It did about $15,000 worth of damage that I wasn't planning on. Now, eventually, after about 3 years, I won a small claims lawsuit against the city for that money to get it back, but I had to front it for 3 years. So that was a great example of how you can use a line of credit to cover expenses. So one of the challenges that we talked about briefly is finding good deals. It's really hard. Prices are high, interest rates are high. So where are the deals happening? Because as an investor, you're typically, if you're going after the same types of properties as owner occupants, it's really tough to be able to buy a property that has enough of a profit margin built in where a seller would accept your offer versus an owner occupant who's not looking at it from that same perspective of having profit built in, whether you're going to flip it, renovate it, whatever it may be. So in my personal opinion, and my investment strategy is to go after properties that need a fair amount of work. And the reason is that a lot of owner occupants are scared by that work. They need to move faster. Maybe it's 6 months worth of renovation and they don't have the time or the stomach or the funds to be able to do it. But those are the opportunities where I think you can make some money. Maybe a seller is getting a little bit desperate. Client just called me yesterday about a property that has a roof problem. The seller doesn't have the money to fix it. And so now they might get a screaming deal on that property if they're able to buy it and use their own funds or maybe a construction loan to be able to repair that property and get the rents way higher. So it creates, having a property that needs work creates an opportunity to build sweat equity and to also get properties at a discount. Whereas if you're competing with owner occupants, that's not likely to happen, right? If you want to have a 20 or 30% profit margin on a property that you're bidding against somebody who's going to live there and just occupy it for the next 10 years, it's very unlikely that you're going to win that bidding war because it's worth more to them because they don't need to have that profit margin built in for either a flip or cash flow or whatever it may be. So in my personal opinion, the deals are happening for investors when there's work to be done, when the property's not in very good shape. And that's all relative, of course. Some of them require more work than others, but there are construction loans. I'm involved in one myself right now where you can build in the cost of construction. So I purchased a property around $1 million. We're converting it from 2 units to 4. And it's going to need about $500,000 of renovations, a pretty big project, because we're adding units and square footage and renovating a very, unrenovated place. So it's a $500,000 construction project. So what we did is we financed both the acquisition and the construction. We ended up putting about roughly 30% down at acquisition, and the lender's funding the entire cost of the renovation. So it's an opportunity, as an example, to be able to build that equity, and we will probably double our money as far as the amount of money that we put in. Take some time, take some energy. Don't ever underestimate that, because when you're taking on a construction project, it can feel like a second job. But for those who are willing to take it on, I do think that there's a window of opportunity for them to capitalize on sellers who are in a situation that need to sell and their property is not really in great shape. But you can fix that, and you can take advantage of that as an investor to be able to capitalize on that opportunity. So one of the other things we started talking about is that it's very difficult as an investor to qualify for traditional mortgages. So traditional options, let's say Fannie Mae, Freddie Mac, and just standard jumbo programs do allow for investment property loans, usually not for construction in the most cases, more for acquisition. But they have very stringent requirements that oftentimes investors don't have. Or if you're trying to be a full-time investor, Oftentimes your tax returns will not show very much net profit because you're hopefully turning over your projects, you're spending money on renovations, you're putting your money to use. But there are some amazing programs that that we have that allow investors to qualify for loans that they otherwise wouldn't qualify for. So I'll give you an example. So my favorite one is called a DSCR loan. DSCR stands for Debt Service Coverage Ratio Loan. So the way that these loans work is an underwriter will analyze based on the appraiser's comments what the property would rent for if it's vacant, or if there's tenants currently, they'll go off of the current leases. And the approval is based on whether the rent is enough to cover the expenses, which on this type of loan, they're looking at the mortgage, the taxes, the insurance, maybe if there's an HOA fee. And if the cash flow is even, they will approve that loan. You still need to have a decent credit score. It doesn't have to be perfect. And you have to have a little bit of reserves in the bank, which is a good idea for you as well. Not just a bank requirement, but a good idea as an investor to have that money sitting around and available for any unexpected expenses. But the underwriting is not at all based on personal income. So you could be unemployed, you could be in between jobs, you could be retired, you could be any of these things, and it wouldn't matter because it's not even disclosed on the loan application if you're employed, what your personal income is. They're just looking at the property and the cash flow of that property in a vacuum. There are even programs that will go to where your cash flow is only, where your income is only 75% of the expenses, meaning you're 25% upside down. And there are programs where there's no ratio calculated at all. Those programs you want to be careful with because you don't want to have negative cash flow. But imagine you're purchasing a property that doesn't have very good cash flow initially, but your plan is to renovate it and get that cash flow way up. You still need to qualify for that acquisition loan before the cash flow is better than it is when you buy it. So sometimes those programs are a way to get into the property, knowing that once you do your repairs and renovations, that your cash flow is going to get better and you'll probably qualify for a better version or a better interest rate on that type of loan. But these are great products for investors because they're very easy to qualify for if you're finding the right property. And of course, that goes without saying that you want to find a property that has good cash flow, not just good appreciation opportunity. You want to get both. Be greedy and be picky with the projects that you choose to take on. Another type of loan is one called a bank statement loan, where let's say you're self-employed and we get this comment a lot from clients are my tax returns don't look, they don't tell the whole story, right? They don't show as much income as I actually make because I have all these extra write-offs and maybe putting money toward a retirement account or whatever it may be. So the tax returns aren't an accurate portrayal. So a bank statement loan basically looks at the last 12 or 24 months of your bank statements. They add up all the deposits, all the money coming in for what looks to be income deposits. And then they look at your expenses, how much money is going out. And that's how they determine your qualifying income. Another sort of similar variation of that doesn't require all the review of bank statements, which is a little more simple on paperwork wise, is something called a P&L loan, profit and loss statement loan, where your accountant would put together what we call an operating P&L, meaning let's say you own a small business. They look at your revenue versus your expenses. They put that on their letterhead, and that can oftentimes show more income than what a tax return would show when you factor in all the other things that a tax return typically includes. So it's another way to be able to not have to show a tax return, but still be able to qualify for a more conventional mortgage. There are also programs that just don't require any debt to income ratio requirement at all. And then there's hard money loans where if you have a property that's in really rough shape and, there's different versions of this for acquisition and construction costs, but hard money is kind of a last resort of financing when conventional financing isn't an option for some reason. But it can be a really, really great tool for investors to be able to pick up, for example, uninhabitable properties, maybe one that had some fire damage or one that is having a roof leak that's, clearly making the property uninhabitable. Hard money lenders will often still lend on those. You're going to pay higher rates, you're going to pay fees and points on those types of loans. But if you're getting a good enough deal on the property, then it might be worth it. And one last creative financing that I want to talk about is a recent change with owner-occupied financing. Now you might be thinking, why is Mark talking about owner-occupied financing? And the reason why is because it doesn't have to stay owner-occupied forever. So recently, maybe a year or so ago, Fannie Mae started a new program or a new guideline where they would allow 5% down up to certain loan amounts, which vary depending on how many units there are. So 5% down on properties that have up to 4 units. And so imagine if you're looking for a place to live and you buy a 4-unit property, you can live in one and still claim that property 100% legitimately as your primary residence as long as you're living there. The requirement from a lending perspective is calling it owner occupied based on what your intent is for the first 12 months. So if you intend to and do actually live in the property for 12 months, you can buy a 4-unit property, theoretically up to, well over $1 million, and be able to live in one, rent the other 3, and a year later, you can move out and you can rent that unit and then do it all over again. So the beauty of doing this, it does require more conventional underwriting, but you're getting also credit for the 3 rental units in this example. So you get to use a portion of that proposed rental income to help you qualify. But the beauty of this is that it's a conventional mortgage rate. So the interest rates are better than they would be for an investment property loan, and allows you to buy 4 units at a time or up to 4 units at a time while still only having to occupy 1. So in some cases, the rent from the other 3 units covers the majority of the expense on the property. And then you have the 4th unit that you're living in. Now you may not be having to pay rent. And the beauty is that you can do that over and over and over every year. You can buy a property, live in it for 1 year, have 3 rental units. Once you move out, now you have 4 rental units. Now you can go buy another one with 5% down. You do not have to be a first-time home buyer for this program. That's a common misconception. So you can actually do this several times, theoretically once a year, if you don't mind moving, of course, because that's sometimes a challenge in and of itself. But there are a lot of great hacks that are associated with investor financing. We do all of them really, and we really pride ourselves on being experts on how to find the right financing for each client situation. So even if you think, oh gosh, I'm never going to qualify for a loan because of X, usually we have some sort of creative solution what we might be able to do. And another thing I always tell people is don't be afraid to invest with other people. So if you're saying, well, I don't have enough money to be able to buy an investment property, well, that may be true, but you might be able to partner up with somebody else. So always keep that in the back of your mind. So I appreciate you guys joining for today's session. This is, again, one of my favorite topics to talk about. I wish everybody knew about all these things, but we'll get to people one by one if we have to. But if you have any questions, you can definitely reach out to us, and we would be happy to do a consultation with you or anybody that you know on how to build your own portfolio and continue to grow it over time. That's really how you create wealth, and that's what we're all about. So thank you for joining us, and look forward to seeing you all next time. Take care.